and 20th of November. And in the last week, particularly in the last few days, we've seen a bit of a change in the character of markets, and this is largely coming from rising bond yields in Europe. We had a pattern unfolding in the S&P 500 index that looked to me very much like it was a pause in an ongoing rally into the end of the year, which made sense from a seasonality point of view. But markets dropped out of that pattern on Thursday and then really didn't do very much on Friday night either. Now it was options expiry week in the US, so sometimes that can have an influence and mess up the patterns. So we really need some more information this week. But unless we see a pretty decent rebound this week, then sentiment may have shifted in the US and hence around the world. So I'm a lot less certain now about where we go into year end than I was over the last couple of weeks. Anyway, let's move on. We'll have a look at first of all the important information about general advice. Just a reminder that you need to make your own trading decisions. We're just providing a framework and information for that. So an action summary of the week: the S&P finished 4% lower, and as I said, the consolidation triangle that would normally point to higher prices actually broke down, and that wasn't a particularly good sign. It's possible it could just be a false breakout and we head back up again, but I would have thought we may have had a more solid rebound on Friday. At least a close on the highs or something of that nature. We've tested the 50-day moving average twice. We'll have a look at the chart shortly, and so that support level is still holding, so that's something. There are some very strong contrarian buy signals based on sentiment, and I've been talking about those in the written daily alerts over the last couple of weeks. So certainly some good indicators that if you take the contrary point of view, would suggest that markets could rally from here. The Australian market closed down 2.8% on the week, so we did a little bit better. That could really just be a timing issue. And again, our 50-day moving average is providing some support, but basically our market is just going sideways. Gold was down sharply on the week, closed $60 lower. And I suspect that this is more about liquidity because it really wasn't that much about the US dollar strengthening. I think it's a case of in Europe that some of the players are getting caught and are having to sell whatever they can. And gold, of course, is always readily liquid. There was a bit of a consolidation pattern in the gold chart as well, and that also broke down. It wasn't as clearly defined as the S&P, but nevertheless it did break to the downside. But from a fundamental point of view, central banks are still buying in record quantities. Some numbers that I saw for the third quarter of this year, central banks have never been buying more gold than they are at the moment. So I think anything that we see to the downside in gold is just a buying opportunity and a magnificent buying opportunity. The only problem is that with so many stresses in the world's financial system, that you're never quite sure where the low point might be. Now, silver is more volatile than gold and will move around in both directions to a greater degree, and it certainly did last week. It was down nearly 7% on the week, but the same comments apply as apply to gold. And it's a small market, so once people start buying silver, it's going to shoot up very, very quickly. The Aussie dollar has dropped back. It's almost right on parity with the US dollar. So it's certainly lost some ground in the last week or two. Now look, it's mainly due to weakness in the euro. So money is moving into the US dollar because the euro is weak. And the rising US dollar is of course offsetting the Australian dollar. So it's not that the Aussie dollar is weak, it's just relativity to what the US dollar is doing. Now let's just have a quick look at strategy before we get to the charts. When it comes to stocks, definitely looking to buy the oversold dips on quality stocks, particularly gold stocks, obviously. But now that I'm a bit more cautious on the market, I really want to see an oversold condition. We bought into a stock, PRU, last week that was in a bit of a consolidation. Didn't really look like it was. It had too much more downside, and we've been caught out there with a bit of a tax rate change. So we still need to buy the oversold dips. Short term, I think taking profits on gold stocks where you're in that position is definitely the thing to do. If you're a medium term participant in gold stocks, then I'd probably hold the ones that are in clear uptrend, but you may get some short term interim downside there. And obviously we're looking to increase our shorting exposure to companies with European debt. We've got a little bit of exposure there, but I'm certainly looking to build that at the first opportunity. So let's get to the charts. First of all, this is the looking at the currencies. This is the euro US dollar exchange rate, and you can see here that we had a substantial fall during 2009, where the euro fell from $1.50 down to under $1.20 as money basically flooded into the US dollar. Then we've had a rebound, and it didn't quite make it back to those highs, so it's formed a lower high at just under $1.50, and now we're heading back down again. It's been very volatile in the last couple of months since August. Well, at the end of August, we've had a substantial fall, another substantial rally, and now we're heading down again quite quickly. And I really do expect to see the euro back down around that 120 level. So let's have a look at the S&P. Now, these charts are not updated with Friday night's data. Obviously there's a problem with the data provider into Market Analyst. So here on the S&P, the last candle that you can see here is Thursday night's candle. I've attempted to draw in Friday night's candle, so that's the range. Between 12:10 and 12:30 is the range, and it closed round about the midpoint. So it's a fairly decent range, but did close around the midpoint. So it doesn't really signal a turning point for me yet. I would have much preferred to have seen quite a small range, and that might have indicated a bit of a short-term reversal. But you can see here we've had this really good move out of the 4th of October. Ran up strongly, hardly any retracing at all. Created this triangular pattern, which normally 8 times out of 10 would signal a continuation to the upside, which is what I've indicated here. But we've dropped out of that triangle quite dramatically on Thursday night, and didn't really recover Friday night. Now, the possibility of this making it back up into this triangle and going higher is still there, but it's a lot weaker now than it was just a few days ago. You can see on the RSI we're not particularly oversold yet on a daily basis. If you go to an hourly chart, we certainly are. So hence my caution in the short term. It really depends a great deal on what happens in the next few days. Now, if this breakdown is significant, and we do have some good support here. I mean, that's around about this 1210 area. There is some good support. It was the 38.2% retracement of this run from the 4th of October to the 27th of October. So we've gone down to that level. We bounced off it Thursday night. We bounced off it Friday night. So there's some good support there. If that support breaks, then we're looking at 1183, but I really think that's probably not going to hold it. I'd be looking at 1158. And if we are slipping into a bigger term downtrend, then I'd be looking for then 1101 and 1019, call it 1020, come into play. at those points. So the next few days is really critical on the S&P, and this is a shorter week. In the US, it's a holiday week, so we'll get some action compressed into a smaller number of days. Now this is the Aussie market. You can see, let me just pan back. We had a big downtrending channel. We broke out of that on the 10th of October, but really haven't gone on with it since then. We've just gone sideways. So our market has really underperformed the US in that sense. You can see we've bounced off this 50-day moving average on 1, 2, 3, 4, 5 occasions in the last few weeks. So a break of this 50-day moving average, which at the moment is sitting at 41.50, is not a particularly good sign. So that's something else to keep an eye on. Now let's look at gold, and again these aren't updated for Friday night, but basically we finished reasonably flat with gold on Friday night, finished just above 1720. So you can see this 150-day, the green line, has been the key support level. We bounced off it on the 28th of September and again on the 21st of October. Formed a little continuation wedge here. Would have expected gold to move higher, and then we dropped out of it Thursday night and again failed to recover at all on Friday. But I'm not at all concerned about gold. If there is any significant dips in gold, I'm going to be buying it with a great deal of enthusiasm. Now, this is silver. There was a continuation pattern here. I expected, sorry, that's not silver. Oh, yes, it is. I expected this to move higher, but again we got a breakdown from that continuation triangle. We're a bit more oversold on silver, so really I'm just looking for any kind of significant move down is going to be a great buying opportunity for silver. So that's all I wanted to cover for this week. I was quite positive about the run into Christmas, and we still may get a positive run into Christmas, but the events of the last probably 2 to 3 days have really dented my view. I'm moving very much to a cautious stance, as you'll see in the daily alerts, and really a lot depends on what happens in this next week. So that's it for this weekend. We'll see you next weekend. Cheers.